Hello everyone, welcome back to our YouTube channel. We are PGN Accounting Group. Today's video is where to invest your money for beginners. But before we get into the video, please hit the subscribe button, follow us on Instagram, and if you want to book an appointment with us or your free initial consultation, then visit us at pgnaccounting.com and book that appointment today. Today's video, where to invest your money for beginners. Again, there's so many ways to invest your money, but we really want to make a pretty basic guide to where you should invest your money, because there's so many different investments that people could put their money in that it seems a little overwhelming. Some people don't even know where to start. So we really want to help those people that don't know where to start, or they kind of dabbled in it a little bit and they kind of want to understand where they could put their money. But before we kind of talk about where to invest your money, please check out our videos, how to win financially and where to save your money, as a foundation for this video, because a lot of the topics and steps that we've talked about previously in these two videos, we're going to be building up on in this video. So go check those out on our YouTube channel and then come back to this video so that you could build up on top of that knowledge after watching those videos. But we're going to be talking about how to invest your money for beginners. First and foremost, we want to talk about your emergency fund. This should not be invested. So many people think that they should invest this because it's going to grow. Why would I keep my money at a 0% interest rate just sitting there? Because that's what an emergency fund is. It's not risky with and put it in an ETF that could lose 20% money in 1 year, just like we did in 2022. Now your $10,000 in emergency fund is only $8,000. And it won't cover an HVAC system if it breaks down in your house because you were risky with it. This should just be cash, cover your deductibles, cover any emergency that you might have. And with the interest rate environment that we're living in right now, you can actually earn 3 to 4% in a high yield savings account. Do not touch this unless it's for an emergency. Putting new rims on your car is not an emergency. Remodeling a bathroom is not an emergency. Do not touch this unless it is an actual, true emergency. Do not convince yourself that going to Mexico is an emergency, because it's not. Unless you have a grandma there or a grandpa or a family member that is sick, then do not justify going on vacation as an emergency, no matter how many hours you've been working to get out of debt. My rant's over. Back to where you could invest your money for beginners. The first step is that you should be taking advantage of your employer's 401k or Roth 401k, because at least contribute up to the employer's match, because it's 100% return on your investment. You're not going to get those kind of investment returns anywhere else, and you get that immediately for the most part, depending on your employer's plan, but most you invest immediately. So take advantage of that. Get that 100% return on your investment. Now, how to invest the money that's in there? I recommend split 25% across the board in each of these four. 25% in your small cap, 25% in mid cap, 25% in large cap, and then 25% in an overall S&P 500 index fund or total market fund if they have that. Now, what does this mean? Cap is capitalization, market capitalization. So that's how big is the company. A small capitalization might be under $1 billion. A medium capitalization company is worth maybe 1 billion to 100 billion. It's a wide range. Large capitalization are those companies that are worth well over $100 billion. So we're talking about JP Morgan, Apple, Microsoft, Tesla. These are large capitalization companies. So we like to spread our 401k across all of these different sized companies. Why? Because some of the small caps might grow large in 1 year, whereas the large caps are well-established companies. They might not grow and fluctuate as much, but they pay a higher dividend. So you want to kind of be spread across all four of these, and that 25% to S&P 500 index fund or total market. I prefer total market if you could find it, especially if your employer has good variety of funds that you can invest in. That way it's invested in the total US plus international funds. So you get a little bit of international exposure there. But if you don't, just invest it in an overall S&P 500 index fund and you'll be fine. And now once you contribute up to the employer match in your 401k or your Roth 401k, then you should be investing your money that you contribute to your IRA or your Roth IRA. And similarly here, you should be spreading it across the board 25% to each four of these. But these are a little bit more specific, whereas here in your 401k, it's very hard to be specific. If you have your money with your employer and they use Empower or Fidelity or American funds, then each one of these employer 401ks are going to have a wide variety of investment funds. So it's very hard to say because it's very specific on the fund with the employer and what they like to offer. So it's very hard to tell you invest in this specific fund because it changes across the board depending on who you work for and what company they are using for their 401k plan. But for your Roth IRA, we can be a little bit more specific because you're managing it yourself. So if you have Fidelity or Vanguard Roth IRA, then you can invest in these Vanguard ETFs or index funds. So I recommend that you invest your Roth IRA 25% into Vanguard Small Cap Index Fund. The stock symbol is VB. 25% should go into Vanguard Mid Cap Index Fund, VO. 25% should go in Vanguard Index Funds S&P 500 ETF, VOO. And lastly, 25% should go into Vanguard Total Stock Market ETF, VTI. Now, this is my ideal diversity of a retirement account or even your taxable brokerage account, but we'll talk about that later. For your retirement account, for your Roth IRA, this is my ideal diversity because you're exposed to small cap, you're exposed to mid cap, and you're exposed to large cap US S&P 500 companies. But you're also exposed to the total stock market, which includes international. But you're not too heavily exposed to international, which historically does not do that great. But you are exposed to it at least a little bit because there are some years where international funds outpace the US funds. So if you can, invest your Roth IRA in these four buckets. Now, your health savings account. I keep saying this almost every single video. Please open up an HSA. Please contribute the maximum you can every single year. It is a triple tax advantage account, and you are doing yourself a disservice by not taking advantage of this. You do need to have a high deductible plan, but I strongly recommend it because you're saving a lot of money on the premiums, and those savings that you're not paying in premiums could go towards contributing to your HSA account, and you can have this roll over year like a bank account until you retire. And you could take out whenever you want. You don't have to wait for retirement. So it's amazing. Not a lot of people know this. You can invest the money that you have in your HSA. It doesn't just have to sit there cash, earning nothing in interest, earning no growth. You can invest this into ETFs, into mutual funds. But again, it depends on where your HSA is being held and what investments they offer, which is why I'm not listing out specific investments here like I did for the Roth IRA, because it's very nuanced on what investments they offer. The principle is still there of what you should invest 25% each into. However, most HSAs require that you keep about $1,000 or $2,000 in cash. and you can only invest amounts above the $2,000. So if you have $10,000 into your HSA, you can invest $8,000 into these ETFs, and the $2,000 has to remain cash. The reason they do that is because you don't want to constantly transfer from the investments to cash and cash to investments. Whenever you want to take out for medical expenses, you always have a little bit of cash there for that readily available cash. And that same principle applies to that emergency fund we talked about. You don't want something to be invested in an ETF that you have to liquidate, then transfer. When you have an emergency, you want that money now. So you can't really have it now if it's not already in cash. So please don't touch the emergency fund. Leave it cash in a high yield savings account. Same thing with the HSA. You have that $2,000 in cash readily available for medical expenses. Now, after you're above that $2,000, invest it 25% to small cap, another quarter into mid cap, 25% to large cap, and that last quarter into an S&P 500 index or total market ETF. Now, after you took advantage of all of those retirement accounts, the high yield savings account and the Roth IRA, Roth 401k, HSA, you can start putting money into your taxable brokerage account. Now this, just like the Roth IRA, you have a lot of flexibility, and I did not change my philosophy on what you should invest in. Whether it's a Roth IRA or a taxable brokerage account, you should still be contributing the same 25% into VB, 25% to VO, 25% to VOO, and 25% into VTI. Very simple, very boring, I understand, but this lets you not have to worry about the daily mechanics of the stock market, which specific stock is up or down. There's no stress. You're covered, and it's not going to fluctuate as much. It's not going to be as heart-wrenching because you're invested across the board into a lot of companies. So you are a lot safer diversifying this way than you are playing individual stocks. But you get the upside, and unfortunately, like it was the last year and a half, you get the downside. But at least these are not going to drop 80% overnight like an individual stock can. Now, again, these were how to invest your money for beginners, for people that don't know where to get started. But for those that are above the beginner level of where to invest your money, these are some bonus topics of where you can invest your money. Real estate. Real estate is by far one of the best investments you can ever do because you get to take advantage of depreciation, so the tax savings on that. You get the cash flow, you get the appreciation, and the debt pay down. So you're building equity in this. There's so many advantages of real estate that I recommend that if you can do everything that we talked about in this and you surpass the beginner level, then please think about investing into real estate. But do it wisely. Do not do zero down payment real estate. Please do it wisely. Build up a savings account so that you can start investing in real estate today. Some other options are artwork. So if you're able to buy a painting, then you don't have to buy those $1 million paintings. There are $50,000 paintings that you're able to invest in. And if you want, you can even use Masterworks, which is a platform that hundreds of people could buy a portion of a painting. So again, I'm not sponsored by them, but do your due diligence. And if you want to use them, please do some research. And if you like it, then you can invest into artwork with Masterworks. There's crypto. Now, again, I'm not endorsing one or the other, but these are your options for investments. There's bonds, I-bonds. That is not an Apple-sponsored product of bonds. That is part of the U.S. Treasury, and they offer I-bonds that are tied to the inflation rate. They've been very popular lately because they had an interest rate of 9 or 10%. So they were a very hot commodity that people wanted to buy. You can invest in U.S. Treasuries or muni bonds, municipal bonds, corporate bonds. You could invest in private equity, angel investing, small businesses. You can also do some private lending for people that need loans for whatever purpose, to grow their business or to invest in real estate, but they can't and go get a loan from a bank. So you can do a private lending to them, or you could collect collectibles or commodities or gold and silver or anything like that. They're investments. So these are all investments for people, but I don't recommend that if you're at the beginner level that you invest in some of these, because that's more for an experienced investor that has a substantial amount of savings and they're able to take a 50% or 80% hit on crypto and it won't bankrupt them. Whereas a beginner that's investing can't afford 80% of their savings to be wiped out in a month because crypto went down really bad, or the private lender can't pay them anymore, so poof, all the money goes away, or a real estate deal goes bad and they lost 30% of their money, or that artwork is depreciating 20%, or there's so many fear-mongering ifs and buts and ors, and I don't want to be that, but please, do your due diligence before you invest in any of these outside of your 401k, Roth IRA, high yield savings account, HSA. Those are the basics for people. Once you do that and you do your taxable brokerage account, then think about these other options. That's it for this video. Thank you for staying tuned until the end. I really appreciate it. And if you want to show a little love, subscribe to our YouTube channel, follow us on Instagram, book an appointment with us at pgnaccounting.com. We hope that you really enjoyed this video and this information, and really appreciate the free content that we provide almost every 2 weeks. We really want you guys to grow, be educated on your personal finances, not just on taxes, but personal finance space. So if you really find it helpful, please support our channel, our Instagram page, and share it with your friends. We'll see you guys on the next video. Goodbye and take care.